Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're just going to look at OPEC and what's really been happening, with Libya news, Iranian news, and really kind of what's happening within the OPEC organization. As we've started to see some shifts as things come to light and as just supply demand starts to shift around the world. So the one thing we really want to jump into is just Libya, because we've heard multiple times about Libya coming to some sort of agreement. We're going to start to see some exports. Well, this one is so far it's the longest that we've seen in terms of some of these agreements with the NOC, or the National Oil Corporation. So here, or National Oil Company, and here you can see kind of where things were as we came into September. They were at a production of about 80,000 barrels. Now, the view is that they can get to about 260,000 by the end of this week. We're assuming that they can get to about 350,000, or that green line, relatively quickly. And by relatively quickly, we're assuming by the end of the month. That red line is at 750,000, just based on where things are getting active, what fields turn on first, just means that they could get to that 750 number, we believe, in the next 6 months. Now, getting to about 1.2 million is or 1.1, 1.2, that range is going to be very difficult just in the near term, if you consider that there has been damage to pipelines, to storage facilities, to loading facilities. So that, again, getting to that 1.2 or 1.1, 1.2 is going to be tough. And that's going to take time and CapEx. So those are things that we have to consider. But just based on kind of where we think things are, 350,000 barrels a day is very doable over the next several weeks. 750 is going to be kind of that target that we think is going to be where things will end up over the next 3 to 6 months. Again, as long as things stay happy, everyone stays friendly, which is always an unknown, especially when we're talking about the Middle East and some of these uncertainties overall. So it's important to appreciate, okay, well, where are things loading? How are things moving? So this is just a chart looking at the loading ports and points in terms of what has been deemed safe, what is the NOC opened. So here in Hariga, Tobruk, you can see that there is an area where only Hariga and Zotina are two areas that have enough oil and storage to sustain an immediate increase in exports. So this is one thing where we think those two areas will see ships coming so far. So Hariga is actually set to receive a ship today. So it'll be a good test to see where things have where things sit. The NOC has given the green light in these three circled areas. They're still waiting for clarification on the other regions. And what they deem as or how they clear it is any type of soldier, whether that be a mercenary or a local Libyan, they have to be gone. They have to vacate the area, and then the NOC will bless it, and they will say, okay, now that we can begin, because the NOC is in control. How the revenue gets split continues to be kind of this unknown. And you might be thinking, well, why is Libya coming back now? Like, why? What changed? And when you look at just the overall economics and the economies of the GCC, or the Gulf Cooperation Council, they were the ones that were helping Haftar keep some of these things closed, providing some sort of cash revenue, some sort of cash movement to keep them solidified. But now we saw the UAE cheat in the sense of they increased, they had a big increase of not only production, but also exports. And Saudi Arabia is struggling under the weight of their balance sheet, which is something we're going to talk about in a few minutes. And again, that cash being removed now means that they are kind of given the sanctioned ability to push forward, to find a way to kind of supplement. Again, I think the way the OPEC nations, especially Russia, are looking at this is going to compete more with U.S. crude and less with Russia and some of the other grades. Again, that it's probably unlikely, depending on how quickly they can move, but it'll be a very measured look, especially as we're in the shoulder season. So this is something to watch as we kind of go forward. And when you just look at kind of what's in storage. So when we talk about things that are in storage, you can see that there's about 24 million barrels, which just means that there is enough in terms of amount in storage and storage capacity. There is enough to increase flow and give time for some of the production facilities to come back, which again is going to be that measured move, which is why 260,000 is kind of the first move. That'll move into the eastern part of the country, and then the western part of the country will start to come up. But Al Sahir is really the big one. That is the one where that is the largest in the country. That's the one that they'll want to see, and El Sidr in terms of just kind of where they want to see, because that Shahara component, they really want to kind of see some of these things move and get more comfortable that they can actually move some of the oil back into this storage and get it to the coast. Now, when we talk about the Saudi Arabia issues, this is an interesting chart that came from the IMF in terms of just the fiscal shortfall. And you can see just how steep it is in 2020. It's not only from weak price, but it's also the fact that their overall economy is just struggling under the weight of COVID. And this is, and again, they have to they're trying to stimulate, they're trying to provide some subsidies, they're trying to, get people back to work, which is what have we seen Saudi Arabia do? They've pulled out of 2 different projects, or at least delayed projects within China and within the region, just to try to preserve some capital to help, stimulate the economy, which again, what other costs can you cut? Well, cost and cash movements into Libya. So this is where we're starting to see kind of these movements overall. And now the problem with Libya coming back, you have to consider, where did we sit in terms of underproduction, overproduction? You can see that Saudi Arabia really saved the deal. And now if you think about, they're the ones that have now the worst balance sheet, or one of the worst balance sheets, how much can they continue to sacrifice? And you can see Iraq continued to move, and the UAE is the one that was the interesting one, where they had that overproduction. But not only did they have overproduction, they also increased exports. And again, it comes down to weaker backdrop on the local level, where there's just less consumption, more going into the export market, which is just putting additional pressure in the global oil market when we look at general supply. Iran is an interesting one that I want to talk about right before we go into Nigeria. So Iran, there's some people seem to be shocked that, they're now open to speaking with the U.S. in terms of these soldier movements. But again, this is what we've been talking about. There is a lot of pressure on that regime internally, as the social shift is real. The generational cycle is real, and they have to do something to try to stem the tide. And again, as the U.S. has renewed sanctions, the UN, we get headlines where the UN sanctions are back, they're not back, people disagree on if they're back. Again, these are just overhangs when you consider how is the regime going to maintain power as we've had more explosions, more internal strife, which is just going to continue to be a problem. And the reason why we talk about that specifically on this slide is because Iran has a significant amount of crude sitting not only onshore, but offshore in storage that could quickly be moved into the market. And if you think about who would that really go after, or who would that impact, it's really that heavy, medium, sour blends, which would be a big hit, especially into Asia, considerably India, which again would hit not only Iraq, but also Saudi Arabia directly. So now shifting into Nigeria, you can see that shipments from West Africa to Asia are set to drop month over month. It's actually supposed to be the lowest since September of 2018, but it's really given based on where are the shipments going. Because here you can see on a Nigerian level, you've actually had an increase of about 11% from some of these key blends, which is that pretty rainbow chart in terms of where the increases are month over month. Now this is going through October. They've already started to post November. Again, it's not fully posted, but you can see that the increase is there in Nigeria, as Nigeria and Iraq have asked OPEC for more time to meet their cheating or their overproduction, because again, it comes down to they need dollars. They need a certain amount of stability by bringing in those dollars to try to supplement and to try to help them, get to the other side of COVID and just this general economic slowdown. So that's where we're starting to see some of these increases. The drop into Asia is really being driven the most into India, as a lot of shipments are not going into India. And Angola has decreased the amount of flow by, so far it's about 100,000 barrels. It could be a little bit less, a little bit more, depending on how it all shakes out, because it looks like we will get some deferrals out of September into October. But again, it's just a matter of just shifting. but India is the one that is seeing the biggest decline in terms of demand, because we already know about Japan and we've already talked about China, specifically in the EIA show. Now, if you watch the EIA show, that we went into detail here, the bigger component is just the oil in transit, which has continued to come down. But this is one that we expect to start to increase in October, specifically as we have an increase from some of the OPEC nations and now Libya. So that's one that we're going to start to see a little bit of an increase over time. Global oil storage still remains sticky. It's really being driven based on Asia, which you can see here that Asian floating storage remains elevated. And just based on how refiners are operating, we just don't see that drawdown really happening, which is something we're going to talk about in the report coming out this week. So when we look at Shandong and specifically the crude oil storage in that area, when we consider, well, how is Asia, or specifically China at this instance, how are they going to offload some of this crude that's sitting in the water? And here you can see crude oil storage in Shandong, or where the teapots are located, are now back at seasonally adjusted all-time highs if you consider where we normally get the drop. They've now reached about 85% of their, or 88% of their allotted oil imports for the year, which is tough because usually by this point in time, they're only at about 65%. So here you can see it's going to be difficult for them to even import more as they continue to operate at elevated levels, which is going to be interesting because this is where a lot of this crude is supposed to be going from the U.S. So the question is, once it comes from the U.S., does it actually get into Shandong? Does it go somewhere else? This is going to be something to watch because these levels are concerning when you look at new purchases, especially because they won't be allowed to import it unless they get a new quota from the CCP, or the Communist ruling party. The one that we want to talk about here and shift a little bit is looking at India. So we talked about Asia in general. Now we have to look at India. So India had a little bit of an increase in crude imports, but you can see that it's really off of this deep low. And the problem is we don't see this adjusting. We see this kind of now flattening out just because we aren't seeing this demand, which is limiting the amount of imports. We've already talked about how refinery utilization rates are going down. They've fallen anywhere from 10 to 15% just because they don't have not only the local demand, but also that export market remains saturated, which even though it's saturated, they have no choice and they're pushing more out. And here you can see why that shift in the market is happening so aggressively, is because we have those refined product exports increasing. When we look at diesel, on a month over month level, it's up 36%. Year over year, it's up 18%. And the imports of diesel are down 93%, and year over year, 79%. So again, they're importing less, exporting more, creating those issues in the market, which again is showing up in Europe, which is going to impact the U.S. exports from the Gulf of Mexico. Now, when we roll in India crude and oil product imports, you can just see just how low things are and how there's really not much happening there. Now, they have some COVID cases have started to ease a little bit, but that doesn't mean that we've seen a reduction in lockdowns. We've seen a little bit more movement on the consumer side, but again, that the trucking still remains very depressed, which is going to be a problem when we consider how are they going to consume diesel, because 40% of diesel demand goes into their trucking and half the trucking fleet is down. So again, it's just going to be hard to see some of that normalization going forward. And then when we look at the overall gasoline, the G20 index has gotten a little bit better. It went from negative 22 to negative 18. There's going to be pressure on this going forward if we start looking at Italy, France, and the UK, as you see some recovery there on the right. Some of it has actually moved into the positive realm, and now we're starting to see that roll over and actually start getting negative again, which is just going to put pressure on gasoline consumption on the aggregate. The U.S. we think is going to stay relatively here, as we talked about in the EIA show. So I don't want to, harp on that too much. The bigger issue is, like, if we look at Saudi Arabia, we look at Indonesia, Mexico. Again, these are some key areas where they're just not going to import as much, specifically Mexico, and they're just going to export, especially Saudi Arabia. If they're not consuming it locally, they're going to put it on the water, and that's going to be a big problem going forward. So that's why we see these shifts overall, which is just going to be an overhang for just general gasoline consumption. Now, Japan, just kind of rounding out how things look overall, Japan remains the problem where through January to July, you can see how far they are in terms of million barrels a day of crude oil imports. And the trend remains down as they continue to experience a significant overhang. And really, 2019 was also a problem. If you look at their GDP, their PMIs, their exports, 2019 was already slowing, and now 2020 is just taking it to the next level. And it's important to appreciate because this is the third largest economy that continues to struggle. And as they're struggling, it's just going to reverberate through the system. And when we talk about reverberating through the system, we have to appreciate just what is happening on the jet fuel side. We continue to see jet fuel demand fall off. And just given where jet is, you can see when we first were talking about this in March and April and then a little bit of May, guys were taking jet fuel or kerosene and blending it into distillate and into gasoline. And we're starting to get back down towards those levels where it just makes sense to take the kerosene and utilize it in a different way. And then now this would make a lot of sense, but we're also having an issue in terms of just overall demand when we look at just net margins across the global refining complex. They remain negative. We continue to see additional shutdowns of refinery utilization rates, not only in Europe, but also in the US, and we continue to see some of this pushback. We're going to go in more depth in the report coming out this week, and just in terms of, well, how deep is it? What is the problem overall? Where are margins going? And who's going to have the biggest impact? And that's where we're starting to see the downtime really start to accelerate, specifically in Russia. Russia is now up to about 790,000 barrels a day that is offline, with about 4.5 million barrels a day offline on the global level, which could drift lower before it gets a little bit better as we get into November. So these are some of the things that we're going to continue to look at. And now coming up, we're also going to talk about on the Econ show, go a little bit deeper in terms of what is really driving the underlying economy. What are some of the numbers mean? And then we'll try to talk about how is that going to impact energy, and what is that, where does this get better? Like, at what point do we start to see that turn as we continue to look at the data to try to find some bright spots and to try to hone in on where should we be looking to get that leading indicator that things are getting better. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.